The European stock markets are following what happened in the Far East, which followed what happened last night in Wall Street. Michael Power from Investec Asset Management joins us on the line. Michael, the volatility appears to have come back with a bang. We had the best day of the year for the American stock market on Wednesday. I'm not sure if it was the worst day of the year last night, our time, but it certainly is bouncing all over the place. What's caught the imagination of the market?
Yes, I think we've reached some sort of inflection point. Quite what's going to happen, I don't know, but it doesn't look particularly good at the moment. I think that the things that are starting to spook the market are the fact that the central bankers of the world seem to be running out of ideas, that the Europeans are conflicted between the Germans and the ECB, with the ECB wanting to do some sort of QE and the Germans saying no, notwithstanding the fact that their own economy now is flirting with recession. We've seen some other indicators like commodity prices starting to gap downwards, oil in particular, which has been fairly resilient until a month ago, but now down 15% plus. And of course, there's no real support coming in any major positive way from Asia. So it all adds up to quite a worrying situation. Of course, on the top of that, we have the strong dollar, but really it's not so much a strong dollar as a weak everything else.
Michael, but these are all issues that we know about. Why in the last 2 days has it been so volatile? And indeed, why after that Janet Yellen-inspired bump on Wall Street on Wednesday, have we now had such a big sell-off last night?
Well, you might ask that. Other people might ask, why is it taking so long for everybody to wake up to what's actually going on and smell the coffee? The fact of the matter is there's not much out there at the moment that's positive. And when you look into even things like U.S. earnings, you find that the entire EPS growth has been manipulated by share buybacks, and that since the fourth quarter of 2011, there hasn't been any organic EPS growth in the U.S. stock market, and it's all been facilitated by share buybacks reducing the denominator.
So a big, deep breath of smelling the coffee. Michael, on another aspect, though, we saw what Timmy was showing us earlier, that the resources shares have been hit harder than most. Why would that be?
Well, I think that, to use a phrase, it's a high beta asset. And I think that, with that strengthening dollar, with the sense that the global economy is slowing down, with the fact that actually there's been quite a lot of new supply that has come on stream in the last 18 months, think iron ore, all of that has combined and conspired to create a situation which isn't particularly favorable for natural resources.
Brilliant insights.
My own view is we've probably got a 3 to 5 year period of lackluster natural resource performance at a dollar level before around 2020 we see a new wave of growth coming out of Asia, this one inspired mainly from Indonesia and India, is going to drive resource prices up again.
Yeah, 3 to 5 years, if we're lucky. Brilliant insights there from Michael Power.